Hello and welcome to Options in Plain English. Today we're going to be talking about a very important topic, option Greeks. And in particular, we're going to focus on delta. What are Greeks? Greeks are indicators that help us measure risk and risk sensitivities for either a position or a whole portfolio. There's many Greeks, but the one we're going to be focusing on today is delta. Delta helps us measure how much the option price is going to change as the underlying price changes. This is critical because most traders start off trading options by trying to make money directionally, and this is exactly the Greek or the indicator that help you gauge how much money you're going to make for every dollar that the underlying price moves. So this is the definition of delta. Delta is the change in option value with respect to changes in the underlying price. So it's the change in option price for every $1 change in the underlying. So what does this mean? Well, it means that if I have this, delta is a number that fluctuates between 0 and 1 on the positive side and 0 and -1 on the negative side. So for example, for calls, it would be positive, and for puts, it would be negative. So if I have a delta of 0.35, for example, for every dollar that the underlying price changes, so for example, an underlying price going from 10 to 11, I'm going to profit by 35 cents per share. So this is a gauge of how much money I'm going to make or lose as the underlying price changes. Now remember, there's many other factors. There's implied volatility, time passing, a change in interest rates, which is not very important, but I'm still mentioning it here. But the critical one, and the one that's always present, is direction, and that's represented by delta as the underlying price changes. We're going to analyze this graph, and we're going to see what happens with the calls and the puts in this analysis. So here we have a graph of calls on the top and puts on the bottom. On the x-axis, we have the underlying price, which is the one that's going to be fluctuating. The strike price is going to be fixed because we're going to analyze what's going to happen to an option after we put on a position. In this case, we're going to simulate that we're going to be buying calls and buying puts. And as the price fluctuates, as the price changes, we're going to see what happens to the delta. Now we know that delta means how much the option is going to change for every dollar that the underlying changes. So we know that for puts here on the left hand side, we have the range going from 0 to 1 for calls and going from 0 to -1 for puts, which means as the underlying starts going higher, calls are going to benefit and puts are going to start losing money. How much? Delta is going to tell you that. So we have here on the top, we're going to take a look at calls. We have a fixed strike price. When the price of the underlying is at the money, it's right here. When the price is higher than the strike price, then the option is in the money, and when it's lower, it's out of the money. Now, at the money, you can see that the option has an approximate delta of 0.50. So when it's at the money, it doesn't matter whether it's a call or a put. A put would have a minus 0.50, but it's the same absolute value. So at the money, you have roughly 0.50 deltas. Now, this curve represents the delta, and you can see that it's not a line. It's a curve that represents how delta changes as the underlying price is changing. So when it starts at the money, it's around 0.50. But if it starts going higher, then it's going to start becoming in the money, and then it's going to be gaining deltas, as you can see. So for example, here, if the price was here, remember, the strike price is fixed. But as it starts going higher, you can see that the delta
started going higher as well. Now here, another thing that you can notice here is that I have four different lines representing delta. This is because not only does delta change with the underlying price, but it also changes with time. So here we're simulating time passing from the solid line to the dashed line to the dotted line to finally the colored line. So you have delta. Let's assume that, for example, nothing happens, that the price is at the strike price, or better yet, let's assume that the underlying price is right in the money, and we're here and time starts passing. So for example, we might have a delta of 0.70 here, and then if it stays there with as time passes, that delta is going to become 0.80, and then it's going to be 0.95, and then at expiration is going to be either 1 if it's in the money, or 0 if it's out of the money or at the money. So you can see how important delta is, and how it changes not only with fluctuations in the underlying price, but also with time passing. This is one of the most important things to understand, that if the price starts changing, your delta changes as well. So for example, if you have an underlying that's trading at $100, and you have a position right here with a 0.60 delta, which means that for every dollar that the underlying price goes higher, your option is going to be worth $0.60 more. However, because the price started going higher, your new delta is also going to be not the same, it's going to be higher as well. This is called gamma, how delta itself changes with the underlying price. And this is something we're going to analyze later on. But for now, just keep in mind, delta is from 0 to 1 for positive values, and it represents how much I'm going to make or lose as the underlying price changes. In the same example, if there's an underlying trading at $100 and it goes to $90, and you had a delta of 0.60, then since it went down by $10, your option price is going to go down by $6, which is 0.6 times the $10 that the underlying price moved. Now here I'm not considering the gamma because I don't want to confuse you guys. Let's start and let's make sure that we understand what delta is. But just keep in mind that delta is not constant, and you can see it here. It changes as the underlying price changes. Okay, so we have this curve. As time passes, it becomes this curve, and then more time passes, and it becomes this one, the dotted one, and then it becomes either 0 or 1. This is the normal progression of delta in time. Now, something similar happens with implied volatility. If we have a high value of implied volatility, it is something similar as if we had a high value of time to expiration. So this curve changing in time could also be seen as the same curve changing as implied volatility declines. So if there's a long time, there's a lot of potential changes in the value of the stock, and there's a lot of potential changes for delta as well. That's why this line is not as sharp as it is when there's a very little time or very little volatility. Both mean that the probability of price change is lower, which means that this curve would be sharper and closer to the 0 and 1 value. When there's a long time to expiration or a high volatility, this delta line is going to be stretched out to encompass several values between the range of 0 and 1. So this is for a call. Price Going higher than the strike price, it becomes in the money. Going lower, it becomes out of the money. And you're going to be making money as the stock price, as the underlying price starts going up. For puts, is the exact same thing but in reverse. If the price starts going down and then it crosses the strike price, it becomes in the money, and then you're going to have values that are higher than, or higher in absolute value, so lower in real value, to lower than the minus 0.5 that you have here. And this is very important because this is going to tell you that you're approaching -1. So if your underlying price is sufficiently deep in the money, at some point is going to start approaching -1, even though it might never, it will never reach it until it expires. But it's going to, if you are very deep in the money, your put, long put, is going to start behaving as short stock. So it's going to start moving 1-to-1 with the reverse, with the opposite of the underlying move. For calls is the same thing. If it becomes sufficiently in the money, then your call is going to start acting as though it was underlying. So basically, as if you had the underlying, it's going to start moving 1-to-1 because delta is going to be very close to 1. And as time starts passing, or implied volatility declining, is going to become 1. So what does that mean, that it becoming 1? If it becomes 1, that means that it expired and then it became long stock. For the put, it's the same thing. If it expires in the money, it becomes short stock because you have the right to sell your shares. Or if you don't have them, then you become short. So this is what happens. So when at expiration, put and calls are going to be either 0 or +1 and -1. And this is what's going to happen upon expiration. If it expires out of the money for both puts and calls, they're going to be worthless. Delta is going to be 0, and they're going to cease to exist. Now, let's analyze what we just talked about and just make sure that everything is clear. And let's have it here in writing. The delta range for calls goes from positive values from 0 to 1, and for puts, negative values from 0 to -1. And you can see that the curve is pretty much the same. It's just going from 0 to 1 and 0 to -1, but the absolute values are the same. For long calls, the out of the money are going to range from 0 to 0.50, and at the money it's going to be approximately 0.50, and in the money are going to start from 0.50 and are going to go as high as 1. It's never gonna be higher than 1, because the most you can have with a call is long stock, which is 1. So basically, when you buy the stock, when you purchase the underlying, you have a delta of 1, because obviously it moves with itself, so it's a 1-to-1. But you can in your mind understand that buying a stock gives you a delta of 1, and selling a stock short, gives you a delta of -1. Now, continuing here, for long puts, the out of the money here are going to range from 0 to minus 0.50, and at the money it's going to be minus 0.50, and then in the money are going to go from minus 0.50 to -1. Okay, calls in a very clear way are the exact opposite of puts. Now, the variables that modify the value of delta, as we were saying, is the underlying versus the strike price. So where the underlying price is with respect to strike price. If it's higher, for calls, for example, if it's higher, it's going to be in the money. If it's lower, it's going to be out of the money. And if it's right at the strike price, it's going to be at the money. We mentioned time to expiration. You can see here, as time passes, this curve starts going closer and closer to 1 and 0. So this is how delta changes. Delta is not static. Delta changes with price, with the underlying price, with time to expiration, and also with implied volatility. What we were mentioning, the calls at expiration that are out of the money and at the money are going to have a delta of 0. So they're going to expire worthless. And the ones that are in the money are going to have a delta of 1. They're going to become long stock. And the puts, something similar. Out of the money and at the money are going to have a delta of 0. They're going to expire worthless. And in the money ones are going to have a delta of -1. So basically, they're going to be short stock. Now, let's take a look at a different type of analysis. In this case, I called it delta per strike for calls and delta per strike for puts. We're going to be fixing the underlying price, and we're going to have several different strike prices along the x-axis. And this is the way we look at the market when we try to put a position on, because we have the stock trading at a certain price, and then we see the options that are available. So different strike prices representing different types of options that are available. Now, of course, when the strike price is higher than the underlying price, then they are out of the money, and they're further and further out of the money, and their delta starts going lower and lower as they go further and further out of the money. And the reverse is true for in the money. So for example, at the money, the strike price, the option with the strike price that's at the money is going to have a delta of around 0.50. But if we pick the one that's in the money, so where the strike price is lower, then it's going to have a higher delta. And then if we pick another one that's even lower, that's deeper in the money, then the delta is going to be very close to 1. So this one is going to be behaving very, very close to how the underlying behaves. So for example, if an underlying is trading at $100 and we have the 0.80 delta strike call, then every time for every dollar, so if the underlying goes higher by $2, then the option price is going to go higher by 1.60. So you can see how important it is to understand what delta we're picking when we're picking an option. Okay, for puts is the other way around. For puts, if we have the underlying price and we look at the strike prices that are below the underlying price, those ones are out of the money. You would need the price to get here and then go beyond that for them to become in the money. These ones are going to have a delta of 0 to minus 0.50. And the ones that are deep in the money, so the ones where the strike price is very high, are going to have a delta that's very close to -1. So they're pretty much going to be moving in an inverse relation to how the underlying price moves. Okay, so again, this is going to start changing as time passes. So if we have at the beginning we have this curve representing the deltas, and then it's going to start decaying, so to speak. So then it's going to become this one, and then it's going to become this one. So even if your price doesn't change, your delta is going to start changing until all of the out of the money options, both calls and puts at expiration, become 0, and the ones that are in the money for both calls and puts are going to become 1 and -1 respectively. So long stock and short stock. We have here the values of the different deltas that we have. So now let's talk about a little bit about deltas in this respect, in this context. The absolute value of delta can be used as an approximation for probability of expiring in the money. So this is a very important use of the delta. So for example, for calls, if we start and we have a certain underlying price and we pick here the strike price that represents the 40 delta, for example, the 0.40 delta, then this strike price has a 40% probability of expiring in the money. If we go further and we pick the 0.20 delta, so the 20 delta, then that 20 that represents the delta, I'm kind of just multiplying it by 100 here, which is what happens most of the time. We refer to deltas in multiples or in the delta multiplied by 100. So for the 20 delta is going to have an approximate 20% probability of expiring in the money. So it's used as a proxy for probability of expiring in the money, both calls and puts. Now just remember, you just have to use the absolute value. So for example here, let's say we have the 70 delta put here. It's already in the money and it has a 70% probability of expiring in the money, even though it is a minus 70 delta, because you're long the put and it represents minus 0.7 delta times 100, because every contract is 100 shares. So minus 70 deltas means there's a 70% probability of this strike price or this option, this put, expiring in the money. So that is a very important use of delta. It's an approximation for probability of expiring in the money. Mathematically, it's not exactly accurate, but it's good enough and it gives us a good sense of the probabilities for that particular strike price. This is what I was mentioning. Since option contracts cover 100 shares or units of the underlying, the delta is often expressed without the decimal point. The 0.30 delta strike can be referred to as the 30 delta strike. This is what I was mentioning. So now, see how important delta is. Now, I don't need to tell you which underlying it is. If I tell you, let's go take a look at Microsoft and buy the May 40 delta call. Now, I don't need to tell you that Microsoft is trading 175 and the 40 delta is probably 182 or 184. I don't need to know that. If I tell you go and buy the 40 delta call, it doesn't matter what underlying it is. I don't need to know the prices. I just need to know that the delta is 40, and I can find delta 40 in every underlying. That's why it's very important. It's like a way of standardizing all the different strike prices that are available for a certain underlying. So this is why delta is very important, because it allows you to refer to a certain strike or to a certain strike price or to a certain price in a 0 to 100 range without knowing what the underlying price is. It doesn't matter whether it is $12 or $100 or $1,000. The deltas are going to be spread out from 0 to 100 or from 0 to 1 in every underlying. Something that we were mentioning also before, delta itself is not static. It also changes as the underlying moves. These changes are quantified by another Greek, gamma, but we're not going to talk about gamma, but just keep it in mind. So when, for example, I was telling you, if we have the at the money put, for example, which has just around minus 50 deltas, and the strike price is 100 and it goes to 95, then it went lower by $5, which means because you had a delta of 0.5 negative, you're going to profit by $2.50. Well, yes, but at the end of that move, you have a different delta. So the move itself moved the delta as well. So delta is really accurate only for small moves of the underlying. Why? Because then delta itself changes and the ratio of the underlying price move to the option price move changes as well. But you just need to understand that, and you just need to know that that's how it works. But you don't need to really understand the details of gamma at this point. We're going to talk about gamma in a different lesson. But right now, you just need to understand what delta is, because from now on, I'm going to assume that you understand what delta is, and I'm going to be referring, seldom will I ever mention a price when I mention a strike price. All the time I mention I refer to a strike price by using the corresponding delta. It's easier. It's easier to understand. Any trader that I talk to is going to understand clearly what I mean when I say a certain delta for an option. Another important thing, the total directional exposure for a complex multi-legged position can be calculated by adding up the deltas for every individual leg of the same underlying. Long stock would contribute 100 deltas and short stock minus 100 deltas. So for example, let's say you have a portfolio and you have 100 shares of the underlying, and you also have one at the money call of the same underlying, then your total exposure, your total the total risk or the total sensitivity that you have to the change in the underlying price is the 100 deltas from the long stock and the 50 deltas from the long call. Now, what if you have a more complex position? You have 100 shares, you have the at the money call, and then you have the 20 delta put. Well, in that case, you have 100 deltas from the long stock, 50 deltas from the from the at the money call, and you have minus 20 deltas from the out of the money put. You would add them up and you would come up with 130, which would be your total exposure. So it's just easy to understand that if you have instruments or financial instruments in the same underlying, and they're stock and options, or options of both calls and puts, or calls and puts and long stock and short stock, you just add them up, and then you're going to come up with your total exposure for your portfolio for that underlying. Do not add up products or instruments that belong to different underlyings. This is only for the same underlying. They're directly comparable, and you can add them up to get the total exposure, but only if it's the same underlying. And finally, the total value of delta for an underlying in a portfolio can be used as a hedge ratio. So the number of shares in the opposite direction needed to become delta neutral for that underlying. So as I was mentioning, let's say you have, same example, 100 shares and then an at the money call and a 20 delta put. You have 130 shares, so 130 deltas. And then let's say that I wanted to go home, and I wanted to go home flat, which is what traders call going home without delta exposure. So if I have, just notice that I have stock, calls, and puts, but the total delta is 130, then if I go to the market and I sell 130 shares short of that stock, then I'm going to become delta neutral. So in a way, delta tells me exactly how many shares I need to buy or sell to become delta neutral. So it's an important indicator when looked at that way as well. It's the number of shares that I need in order to be delta neutral, or partially neutral, or semi-neutral, or I want to hedge half of my exposure, or 70% of my exposure, or whatever it is that your trading plan calls for. Delta is used for that as well. So if we summarize what delta can be used for, it can be used to quantify how much money you're going to make or lose as the underlying price changes. Okay? Number two, it could be used as a proxy for the probability of expiring in the money. Okay, and 3 is the hedge ratio. It's the number of shares that you would need to become delta neutral. Okay, so right there you have 3 uses for delta, and also you can easily refer to any strike price without knowing the price of the underlying or anything, just by referring to the delta value. So if I tell you buy the 80 delta call, sell the 40 delta put, buy the at the money call and the at the money put, which would make you pretty much flat. Any one of those positions, you don't need me to tell you which price I'm referring to. By knowing the delta, you're going to be able to go and pick the right one, the one that I'm referring to. And traders use it all the time. With every trade, you look at your deltas. When you look at your portfolio every morning, you look at your deltas. This is the main risk, directional risk. Is the risk that you think about when you're thinking about trading options. Now let's quickly go to our trading platform and take a look at options for John Deere. DE is the ticker symbol. We're going to open up June, which has 54 days to go. The stock is trading at 138.63. We're going to open up 14 strikes here. So at 138, I would say the at the money is between the 140 and the 135, but I would go for the 140. This is the at the money. Okay. So we have here the column for delta right here. Okay. And as you can see, the delta, this is the calls. These are the in the money calls, out of the money calls, out of the money puts, in the money puts. So this is delta for the calls. At the money is just about 50. And then it starts going higher as you go in the money. 59, 66, 73, 79, 82, 87, 89. And as you go further out of the money for calls, it starts going down. 41, 33, 24, 17, 12, and 7. And for puts, it's something similar. We have the delta right here. At the money, just around 50, minus 50. You can see the negative sign here. And then starts going lower as you go out of the money. 41, 33, etc. 26, 20, 16. And then as you go in the money, they start going higher. 59, 69, 79, 90, until you go sufficiently in the money for puts where the delta is pretty much 1, minus 1. So minus 100 deltas for a very deep in the money put. Now, if we are curious as to what will happen if we go to a month, to an expiration that's further away, we can come here and you can see that the deltas are a little bit different. So for example, the let's take a look at the 120 call, which is it has a delta of 79. It's in the money call. The 120 call in September, so it's 145 days to go. The 120 call has a delta of 73. So if you remember, as you start getting close to expiration, your in the monies are going to go towards 1 or minus 1 for puts, and your out of the monies are going to start going towards 0. So for example, the 170 that's out of the money for calls in September have a delta of 21, but in May, so with less days to go, with less time to expiration, the 170 calls, the same ones, have 7 deltas. So 21, 7. So these ones are going from a month that's far away to a month that's closer. You can see they're heading towards 0. So from 21, 7, if I go closer, it's going to be close to 0. And the same thing happens for puts. Let's take a look at an example. Here, the 170 put, remember, the stock is trading at 138. The 170 put is trading at this value, at this price, But the important thing is the delta is -1. But for September, the delta is actually minus 0.82. So it's not yet short stock. It's only 82% of short stock. So you can see how different it is between the different months and the different expirations. So I hope that this lesson was helpful and that it can help you understand what delta is and how to use it. Delta is used all the time, and you're going to be a better trader if you know how to use it effectively, and it's going to become second nature for you. Option traders, they might not know a lot about their positions, but they know their deltas and their delta exposure. And delta is the exposure that makes or loses the most money for an option trader. So I hope this is clear, and leave any question or comment on the comment section here, and I'm gonna try to answer any questions that you have. And thank you for your attention. Goodbye.